A functioning economy requires a mechanism to turn dormant assets into active capital. Financial instruments are the gears that make this conversion possible, driving economic growth by translating a nation's baseline wealth into tradable securities. Developing nations face a persistent trap when seeking this liquidity. They typically rely on two destructive methods: rapidly extracting and selling their physical resources, or entering the debt chain, borrowing heavily against uncertain future tax revenues. Look at these stacks of raw copper being hoisted away. This represents the physical liquidation of foundational assets. The nation trades its permanent intergenerational wealth for temporary fiscal relief, losing the underlying asset forever. The non-sale doctrine outlines a different path. It establishes the core principle of sovereignomics. A nation can generate internal liquidity by collateralizing its assets without permanently selling the resources themselves. Liquidity is a designed internal outcome of structured asset ownership, rather than an external injection of foreign capital. The Nchongayuk financial instruments framework provides the exact architecture to solve this liquidity paradox. This architecture relies on three sequential layers built into a central bank's balance sheet: stability and governance at the base, liquidity and capital formation in the middle, and mobilization and public participation at the top. Within these layers are 9 specific foundational instruments. They are designed to collateralize and mobilize national wealth at every stage of the economic cycle. This entire flow is powered by the Sovereign. It is a coordinated mechanism of institutions that certify, insure, and circulate these assets up the chain, converting dormant value into market-ready capital. This framework reorganizes the sovereign balance sheet, managing untapped natural wealth as a continuous engine of sustainable liquidity. Layer 1 is stability and governance. This is the bedrock of the system. It establishes credibility and long-term fiscal sustainability long before any market interface takes place. The first instrument is reserves. Unexploited hydrocarbons, carbon sinks, and minerals are precisely quantified using a sovereign asset index to serve as collateral backing. This vast, untouched terrain holds immense sovereign value exactly as it is. It functions as a dormant ecological reserve without requiring a single excavation. The second instrument is trusts, such as natural resource sovereign trusts or ecological preservation trusts. These legal entities shield the reserves from political interference and secure equity for future generations. The third instrument is funds. Sovereign wealth funds and development funds pool this verified capital to direct long-term investments into national infrastructure and economic diversification. There is clear historical precedent. The Norges Bank in Norway translated temporary subterranean oil wealth into an enduring sovereign fund that generates returns today. In Africa, specific institutional stewards manage this layer: the African Continental Wealth Fund and the African Development Bank. The African Development Bank provides the necessary concessional finance, policy expertise, and infrastructure investment required to support this foundational layer. Without this stabilized bedrock of verified, trusted, and conservatively funded reserves, any higher-level financial instruments would quickly collapse under market scrutiny. Layer 2 is liquidity and capital formation. This is the engine that transforms the latent value secured in Layer 1 into dynamic, usable capital streams. The fourth instrument is credits. Carbon sequestration or biodiversity offset credits monetize non-extractive ecological functions, turning the act of preservation itself into a tradable sovereign asset class. We can measure the active absorption of carbon dioxide by dense forest canopies. That real-time quantification forms the strict data backing for these credits. The fifth instrument is loans. Resource-backed and deferred extraction loans allow states to secure development finance using their in-ground assets as collateral, deliberately delaying early extraction. The sixth instrument is futures. Forward contracts for critical mineral delivery or green energy generation allow states to monetize their future production capacity to secure upfront capital today. This vast aerial savanna illustrates unexploited geographic potential. Nations can write renewable energy futures against these optimal corridors before a single turbine is constructed. Two governing institutions manage this layer: the African Investment Bank, which allocates the capital, and the African Monetary Fund, which stabilizes macroeconomic integration. By collateralizing future value and ecological services, Layer 2 introduces internal liquidity channels that provide an alternative to conventional external borrowing. Layer 3 is mobilization and public participation. This acts as the ultimate market interface, enabling broad capital mobilization from both the public and private sectors. The seventh instrument is bonds. Natural resource-backed bonds and ecosystem services bonds raise long-term fixed income capital linked directly to sovereign collateral and verified sustainable outcomes. Intact deep wetlands like this provide measurable water filtration and flood control. Those specific ecological services directly secure and validate high-yield green bonds. The eighth instrument is shares. Geoscientific equity shares and ecosystem service yield shares allow investors to purchase a percentage of the yield without transferring any sovereign land rights. The ninth and final instrument is shields. These are crucial legal and financial defenses, such as sovereign asset protection clauses and litigation shields, that provide political risk insurance and guard against predatory disputes. A regulatory triad makes this layer safely investable. The African Securities and Capital Markets Authority handles regulation. The African Credit Guarantee and Insurance Corporation provides credit backing, and the African Green Ratings Agency handles ESG and sovereign ratings. These bodies enforce rigorous standard setting and conduct independent environmental assessments to strictly verify all green financial products before they hit the market. Layer 3 enables sovereign wealth to interact with global capital markets, bridging the gap between isolated national assets and globally recognized highly liquid financial products. How are these 3 layers, 9 instruments, and multiple specialized institutions coordinated across an entire continent? The solution is the African Legal and Financial Instruments Authority, or ALFIA. It is a centralized Pan-African institutional ecosystem designed to govern the entire framework. Operating at this scale requires integration within the existing African Union framework to provide continental legitimacy and geopolitical weight. ALFIA oversees the Sovereign. It pipelines the data from physical infrastructure at the top down through the institutional nodes, connecting back directly to the geological bedrock. ALFIA operates through specialized divisions, spanning capital markets, monetary instruments, and structured products that are responsible for harmonizing laws and enforcing the non-sale doctrine. This harmonization relies on a strict legislative reality. Member states must formally ratify intergovernmental treaties and legal charters to align their national codes with the continental standard. ALFIA provides the legal coherence and sovereign backing necessary to make the Nchongayuk framework a reality. It shifts Africa from a passive resource exporter to an active financial architect. The ultimate real-world outcome is practical and scalable. Nations can finance heavy infrastructure, manufacturing, and technology without permanently surrendering their foundational resources. Advanced development is built in direct harmony with preserved natural wealth. The asset base remains intact while economic progression moves forward. Escaping the debt chain requires Sovereignomics. It proves that lasting wealth and immediate liquidity can be generated simultaneously without relying on depletion. Financial instruments are the engines of liquidity. Sovereignomics structures sovereign assets into reserves, trusts, funds, credits, loans, futures, bonds, shares, and shields, creating sustainable liquidity while preserving national wealth for future generations.